Hello and welcome again. In the last lesson we looked at the income tax pro forma. In the income tax pro forma we also looked at the sources of income from which we can earn the income. Them sources are called income tax components. Now the income tax components we listed in the income tax pro forma are the ones from which we can earn the income and we have to pay tax on that. Now them are not only sources of income. Obviously you can earn some sources of income from something else as well, alright, on which you don't have to pay tax. Now the sources of income we listed in the income tax pro forma yesterday were the ones on which we have to pay tax. Today we will look at sources of income from which although we can earn the income but we don't have to pay any tax on that, and them sources of income are called exempt sources of income, and that because they are exempt and we don't have to pay any tax on that. Now please look on your screen now as I will share the sources of income with you. I will look on my iPad and I'll share it with you through my computer. If you look at your screen now, please, here you go. It is called exempt income on the screen. Now this exempt income, this is the list of income which are absolutely exempt because we don't have to pay any tax on that. What are these? First of is called income from national savings certificates. Now these are the certificates from the government where you put some money in the where you put some money to buy the certificates and you earn some income, but you don't have to pay any tax because this is exempt income. Next one of the list is called premium bond prices. Now these are the bonds by the government as well that on which you have to on which you can earn some income through prizes. Now if you earn some prizes, then this is also source of income which is exempt and you don't have to list them into the income tax pro forma, and also you don't have to pay any tax. So what you need to do is you just simply need to write it down that this is exempt source of income and we don't have to pay any tax on that. Alright, next one on the list is called scholarships. I hope you understand that when you win any scholarship, when you earn any scholarship to study, then you don't have to pay any tax on that. Next one is called betting and gambling. When you bet on something and you earn that betting, then you don't have to pay any tax. Likewise, if you earn any gambling, say for example, if you go to casino and you are earning something from the gambling, in that case as well you don't have to pay any tax. Alright, next one on the list is called ACCA. Now please remember, don't confuse it with the International Standards on Auditing. If you've already passed F8 or P7, you might think that it is auditing ACCA. It is not that one. It is something called individual savings account. It is a type of account where you put the money to earn some interest, and it is specifically for investment purposes. So that is the government kind of a thing where government encourage someone to put the money into this account, and that's why it is called that's why it is exempt. Next one is child benefit. Now child benefit is simply amount paid by the government to parents to look after their kids if they are earning up to specific amount. If they are earning too much, then obviously you won't be able to get the child benefit. We will see later in the details about the child benefit, but for now it is simply the amount which is paid by the government to the parents to look after their kids. Right, so this is the list of income from which we although we can earn the income, but this is exempt from taxation, UK taxation. Next one is interest income which is received net. If you remember from your previous lecture that I told you that when we receive the income, we always need to multiply it by 100, divide it by 80, because we have paid 20% tax on that. That's why we need to gross it up. But there could be interest which we have received gross and no need to gross it up. So interest could be in two ways. One is which is received net, we need to gross it up, multiply it by 100, divided by 80. Other is which is received gross, no grossing up needed. Alright, so first one here is which we need to gross it up. So what are those? This is the list of those. First one is bank interest. When we receive the bank interest, we need to gross it up. Second one is building society interest. Say for example, if you've invested in the building society and while you're buying some home or something like that, then if you earn some interest on that and that is received net, you need to gross it up. Last one on the list is interest on debentures of unlisted company. Now unlisted is a key word here. because if you are earning interest on debentures of an unlisted company, then it will be received net. If you are earning from a listed company, interest on debentures from a listed company, then it will be received gross. No need to gross it up. All right. I hope that at this level you know what debentures are. All right. Next one on the list is interest income received net. Received gross. So this one is the income which is received gross and no grossing up needed at all. All right. No grossing up needed because it is already received gross. First one on the list is National Saving and Investment Bank account. It is a type of account which encourage investments. So if you put the money for the investment purposes into the National Savings and Investment Bank account, it is always received gross. Next one on the list is interest on gilts. Now, what are gilts? Gilt is simply government security. It could be government bond or something else. All right. So gilt is simply a type of government security, which you can buy and which you can earn some interest on that. Next one on the list is interest on debentures of a listed company. As I told you earlier, if it is unlisted company, it will be received net. If it is a listed company, then it will be received gross. All right. Now, if you look at the if you look next is deductible interest. All right. Next one on the list is deductible interest. Now, what is deductible interest? Now, deductible interest is simply interest which you have paid on the loan. All right. So obviously, when you took some loan, then you have to pay interest on that because no one gives the loan for free. Obviously, so when you go to the bank and take some loan, and the government says that we will charge that interest. All right. It always happens. But when you take the loan, there is a purpose behind it. There is a reason behind it. Why did you want the loan? Why did you took the loan? So say for example, if you needed to buy the car, if you want to build your house, if you want to renovate your house, or if you want to pay for health insurance or something else. All right. So there could be reasons. It could also be a reason that if you want to invest that money into the bank, into the business of your own. So if you are taking the loan for one of the following reasons, then interest paid on that loan will be deductible interest. All right. So what are those reasons? Please see on your screen. Interest paid on loan taken for one of the following purposes is deductible. Now, what are the purposes? If you have taken the loan to invest in partnership business, obviously, then that interest paid on that will be deductible. Next one is plant and machinery purchased for partnership or employment purposes. So for example, if you took the loan and you use that loan to buy the plant and machinery which will be used in the business, then that will be interest paid on that will be also deductible. Next one is to acquire ordinary share or lend money to a closed company. Say for example, if you took the loan and you have used that loan to buy the shares in a closed company. So if you took the loan to buy the shares in a closed company, or you use that money to lend to closed company. So you took the loan and you lend it forward to a closed company, then that interest paid on that loan is also deductible interest. Now the key word here is closed company. You might not know at this level what the closed company is, but closed company, there is a separate full lecture on that, chapter on that, on closed companies. But closed company is simply a family owned company. Say for example, if there is a company and I own some shares, my wife owns some shares, my kids own some shares. So if it is a closed company, that's why it is called closed. So it is owned by the close family members. That's why it is called close family members. But we'll see in details that why we need the closed company, why is it called, and what are the reasons behind it. But closed company simply at this level, closed company is a company which is owned by close family members. All right. Next one is investment in employee controlled company. So if you put some money in the employee controlled company, so the company where the employee has the control. So in that company, if you put that money, then that will be also interest paid on that will be also deductible interest. So if you took the loan to pay inheritance tax on deceased personal estate, so you took the loan and you use that loan to pay the inheritance tax that interest paid on that is also deductible. Next one is investment in cooperatives. Now, cooperatives is the institutes in the UK, and if you put that money in to invest in cooperatives, then interest paid on that is also deductible interest. All right. Now, if you see after that, it says personal allowances. See note 4 of P6 lecture notes. Now, if you come to your lecture notes, which I hope you have downloaded already, and if you come to note 4 on page 2 of the notes, sorry, on page 3 of the notes, I'll just share on the screen with you as well, so that you know what it is. That is the page 3 of the notes, and it says note 4. All right. So on the note 4 of your lecture notes, if you come to note 4 here, that is personal allowance. All right. Now, from your earlier studies, I hope that you know. Sorry, not from your earlier lecture. I hope that you know what personal allowance is. All right. Personal allowance is simply the amount up to which, if you are earning up to that amount, you don't have to pay any tax. And that figure was, if you remember, it was 10,600. So if you're earning up to that amount per year, you don't have to pay any tax. And this figure is 10,600. So if you're earning up to that amount, you don't have to pay any tax. Why did the government use this figure? Why not more than that? Why not less than that? Because government thinks, after their research, that this is the amount which is needed for a person to survive in the UK, to pay rent, to buy food, and to do other expenses, to buy clothes as well. So if you're earning up to that amount, you don't have to pay any tax. If you're earning more than that, then you have to pay some tax. All right? But who is eligible to this allowance? Is everyone eligible? Yeah, of course. So in the UK, every individual is eligible to 10,600 per year personal allowance. If they're earning to this amount, up to this amount, you don't have to pay any tax. Every individual, except for the ones who are earning more than £100,000. All right. So if you're earning more than £100,000 a year, then you might think you are lucky. But although you are lucky, but you won't get this personal allowance. You will get reduced personal allowance or no personal allowance at all. We'll see in a minute why. Now, because government thinks it is also per year. Because government thinks this is too much money, £100,000, and I hope you would appreciate that £100,000 a year is too much money. So if someone is earning £100,000 a year, they don't need personal allowance, do they? Because they're already earning too much. If the government is giving benefits, to the poor people who are earning less amount, up to that amount. Government won't give benefit if you're earning more than £100,000, because government thinks that you're earning too much money. All right. So that's why government says, if you're earning more than £100,000, tell us how much more are you earning. Then according to that, your personal allowance will be reduced, or you will get no personal allowance at all. All right. So how we know that? There is a formula. So whatever you're earning, say for example, if I am earning £105,000 a year, all right. Say for example, I am earning £105,000 a year. And so what do you think? Will I be eligible for 10,600 personal allowance? No, because government says if you're earning 100,000 or more, then your personal allowance will be reduced. All right. So how it will be reduced? What is the threshold of the government? £100,000. All right, to get this personal allowance. So I will deduct £100,000 out of these. So that was my salary. I will deduct the threshold, which is £100,000. Remaining one is £5,000. All right. So I will divide it by 2. Whatever the answer is, this is the amount by which my personal allowance will be reduced. All right. So I will take 2,500. I will deduct this one out of this one. All right. So whatever the answer is, that will be my personal allowance if I am earning £105,000 a year. All right. Now, although I have listed down here, but what are these figures? What is this figure? All right. Now, this figure is called adjusted net income. Alright, this one is adjusted net income. So if your adjusted net income is more than £100,000, in this case my earning was more than £100,000, in this case it was £105,000. And what is adjusted net income? We know what net income is, don't we? In the last lesson I showed you the pro forma, and you can now see in your notes as well the income tax pro forma. It says net income before personal allowance. If you see, net income before personal allowance. Here you go, I will write it down. Net income, it is before personal allowance. So whatever is here, net income before personal allowance, alright, I will deduct personal pension contribution. Personal pension contribution from this one. I will deduct personal pension contribution, and that figure is called adjusted net income. Right? So net income before personal allowance, into your notes, net income before personal allowance, this will come here, and you can see into your income tax pro forma. If we deduct the personal pension contribution, and the answer is adjusted net income. Now, what is personal pension contribution? I told you a little bit overview of pension in the last lesson. The pension is simply amount which you put on side, so that when you retire you can rely on that amount instead of relying on the government benefits. And government encourages if you put that money on side for the future needs. Right? Now, pension could be made in two ways. One is personal pension, which you put the money on side and you go to bank and make your pension, right? And pension could be made with your employer. That is called occupation pension. So one is personal pension, other one is occupation pension. So pension could be made in two ways. So what is personal pension? If I don't go to my employer and if I go to someone else and ask them to make my pension, that is personal pension. Another one with the employer is called occupation, because it is based on your occupation and your employer is responsible for that. Excuse me. We'll see later in the details about that. But for now, as you can see here, personal pension contribution, so that is not occupational, that is personal. You're putting your money to someone else to make the pension, and that is, if you deduct this one out of net income, whatever comes is adjusted net income. Alright, so adjusted net income is this figure. So if my earning is adjusted net income is less than this one, £100,000, then I will be eligible to 10,600 personal allowance. If it is more than that, in this case adjusted net income is £105,000, then my personal allowance will be reduced. Right? How much it will be reduced? I will have to deduct £100,000 out of my adjusted net income. Whatever comes, I will have to divide that by 2, and that is the amount by which my personal allowance will be reduced. In this case, my personal allowance is reduced by 2,500 out of 10,600. Right? So that is the way to reduce the personal allowances. All right. Now I will give you a little example here. If you assume my earning is this much, £110,000 per year, and this figure adjusted net income. Say for example, if my adjusted net income is £110,000 a year, how much would be my personal allowance? Now please pause this video now and solve this amount, solve the figure of my personal allowance if my adjusted net income is £110,000. Please pause the video now. And now I hope you have solved the question. And now if you see my adjusted net income is £110,000, what I need to do is I have to deduct the threshold, which is £100,000 from this one. Whatever the answer is, I will have to divide it by 2. The answer is the amount by which my personal allowance will be reduced. It is £5,000 in this case. This is the amount by which my personal allowance will be reduced. So 10,600 and minus £5,000. I assume it is £5,600. Please use your calculators to recheck it. £5,600. That is my personal allowance, right? Why is this amount? Because my earning is £110,000 a year. My adjusted net income is £110,000 a year. That's why I get reduced personal allowance, because government thinks I'm earning too much money and I should be given a reduced personal allowance. All right? Now, if you come to your notes again, please, and note 4 of your notes on page 3, please. Now, it says personal allowance given in the exam tables. Now, as I told you in the previous lessons, that in the exam itself, you will be given a tax table, which consists on about 4 or 5 pages. Now, on those first 4 or 5 pages of your exam, and it will be tax table where the tax allowances will be given, like personal allowance, and there will be tax reliefs given, there will be tax rates as well, and there will be exemptions and blah blah blah. There will be lots of stuff, right? We'll see later in the next sections as well. So one of the things which will be given to you in the exam is personal allowance, and this is the amount 10,600. This is the figure which will be given to your allowance, and £100,000 a year. This is also the figure which will be given to your allowance. So that if you're earning 100,000 per year or less than that, if your adjusted net income is that much or less than that, then you will get 10,600 personal allowance. If you're earning more than that, in my case, I was earning 105,000 per year. My adjusted income was, then my personal allowance will be reduced. And how much? I'll deduct the threshold and I will divide it by 2. This is the figure by which my personal allowance will be reduced. All right. So here in the notes, please, personal allowance is 10,600 if adjusted net income is £100,000 or less than that, as I told you here. After that, it says note A, adjusted net income. What is adjusted net income? It says total net income after deductible interest. Now, after deductible interest is the amount which is before personal allowance. So net income before personal allowance is the same thing which it says in the notes after deductible interest. If you go to your page 2 of your notes, you will see this figure is exactly the one which is saying on your notes, note 4 here. Right, this is the figure, exactly that one. So total net income after deductible interest, and if we deduct personal pension contribution out of this, which is obviously gross, and the figure which comes is adjusted net income. And adjusted net income in my case was £105,000 a year in my case. All right. Now in note B it says adjustment to personal allowance of 10,600 if adjusted net income exceeds £100,000. Now if it is more than £100,000, then what you need to do is you will have to read this, because I've already explained here. Please read this from your notes. All right. So that was personal allowance itself. All right. Now after doing this one, I hope that now you understand what the personal allowance is and how we can calculate it. All right. So in the exam itself, say for example, if you come to if you come to note 3 again, please, at the end where it says exam tip on page 3 of your notes, at the end it says exam tip, personal allowance will be nil, will be 0 if adjusted net income is £121,000 and 200 or more. Now I hope that you would appreciate the fact that why did he told us this amount, 121,200. Say for example, if I am earning 121,200 a year, what I need to do is, that is my adjusted net income. I will need to reduce my personal allowance. What I will do, 10,600, I will deduct this amount, and whatever the answer is, I will need to deduct the £100,000 out of this. That is the threshold. Alright, so when I deduct this amount, it says 21,200. Alright, what I need to do is, just like here, I will need to divide it by 2. It comes to 10,600. Alright, so that is the amount by which my personal allowance will be reduced. Now you already know that my personal allowance, your normal personal allowance is 10,600. Alright, so if you deduct the 10,600 again out of this one, I hope that you know the answer is nil. Alright, so that's why it says in the question, if it says your adjusted net income is 121,200 or more, then you don't need to do all this calculation. You just can say in the question that because it is too much, the person is not eligible to personal allowance. Alright, so for example, if I'm earning more than 121,200, that you already know that this amount will be more than this personal allowance. And also please make sure that this personal allowance cannot go into negatives. Maximum it can go to nil. So maximum we can reduce this personal allowance is to nil. We cannot go into negatives. Alright? Please make sure you write it down. Because sometimes, say for example, if this figure is more than that, say for example 130,000 pounds, then I hope you would appreciate that this figure will be higher as well. And this figure eventually will be higher. So if you deduct, say for example 11,000 out of 10,600, this will be positive figure which we can't deduct. Alright, because personal allowance cannot go into negatives. It can always maximum go to nil. Alright, that is the maximum personal allowance could be reduced to. Alright, so that is it for now. We have covered the personal allowance and the exempt income. In the next lesson I will see a little bit more things of out of the income tax pro forma. Alright, that's it for now, and I will see you in the next lecture then. Thank you.